Hello and welcome to another edition of Deal Hunter. I'm your host, Mitch Flax, founder and CEO of Net Equity Capital. As always, my co-pilot, Tom, it's good to see you. How are you?
Good, man. It's been almost a month.
I feel like it's been a little bit of time after I finished my Kaya exam, which finally got that out of the way. I was stuck in my office studying 8 to 10 hours a day. No drinking, no fun. I'm happy to have that behind me and anxiously awaiting the results. So more knowledge, very happy about it. Learned a ton of information on evaluating investment. Really interesting stuff, actually. Everyone always complains about the math and why you need to remember formulas. One of the things that I came away with was whether it's private equity, venture capital, or real estate, substitute any, a business for a real estate project. Really kind of the underlying information that goes into some of these formulas are really all the same. Cash flow is cash flow. So it was kind of cool to see the inner workings of some of these formulas, but I've been having some fun lately. I went skiing in Telluride. I went golfing in Palm Springs, but it's good to be back here with you and talking about your next deal. Yeah,
that's right. Yeah, we're also busy too. We've the last 4 weeks acquired almost 700 acres around Austin. And then it's crazy. One of our projects up in Temple that we didn't make public for investing, but just Facebook just announced an $800 million investment in a data warehouse 4 minutes from our location. So just, luck was on our side there. But yeah, I haven't had as much fun. Did have a business trip in Cabo with the team, and we have another trip in New Orleans next week. But yeah, so let's talk about this deal.
I'd love to talk about this deal. We are calling this deal the Seguin 80. And if you've listened to us before, one of the ways, or the way I look at deals is in 3 different components. I always evaluate the first being the market, the second being the property, and third, I think as importantly, if not more importantly weighted than the others, is the operator. And so I'd love to talk about the market on Seguin 80. This probably fits into the San Antonio MSA. Would that be correct?
Yeah, more. So it's about 50 minutes northeast of San Antonio and about 45, 50 minutes south of Austin, right? So, and again, for all you are listening, many people here that are in development do believe that the San Antonio and Austin MSA will merge into one in the next 10 to 15 years. So
I could see that happening, and perhaps maybe we get a better airport out of this. I have no idea, but the long lines at TSA, not sponsored by Clear, but you should buy Clear. That thing is awesome. I get right to the front of the line with my TSA. So free plug for you, Clear.
Yep.
So talk to me a little bit about Seguin. I've been there, really kind of a beautiful little place currently that's, I think, undergoing some rapid growth, just like feels like everywhere else in Texas. But give me some insight into why we should care as investors about.
Totally. Yeah. So a lot of pieces, but I'll hit on a few. So we all know right now, obviously there's a supply and housing crisis. Even with increasing rates, we're so far behind that it's still pretty damn dire. So when we look at projects, we like to play in what we think is the safest category. And what that means is homes that are, building or selling for the very high 2s. And the only builder, by the way, that's doing upper 2s is like KB Homes or Lennar. Very hard to produce a home and make money under $300,000. So we try to find opportunities in that upper 2s to $500,000 price point. What does that mean? Well, we buy land and develop lots and sell them to builders, assuming that the price points they'll build are in that price point. We do that because we believe that in a downturn or a very high interest rate market, that segment's always going to have demand. If it's not for the entry level home buyer, it's going to come from the hedge funds that are buying all these assets as rentals, right? And so, truth be told, this community, we haven't even started negotiations yet with builders, And we already have one build to run person coming at us to take down the whole thing. So long story short, Seguin is a market that caters to that price point, 300,000 to $500,000. The economy itself is, advanced manufacturing, somewhat blue collar, right? And we expect that to grow obviously in the type of jobs and the medium income. But if you look at the numbers, population growth is on fire. The city knows it. They've approved 20 new developments throughout the city, expecting over 13,000 homes in the next 3 years that need to be built. So it's on fire down there. I believe the population growth is like 9-10% year over year. So, 8 times faster than the national average. Median income growth or median income is growing at a clip of around 10% year over year. So faster than the national average. So generally we're pretty bullish. And of course, as we all know, Austin gets more expensive. People move out. Well, a 30 to 40 minute drive is not too far from Austin, and it's right in the middle of that in San Antonio. So we very much like the area. The city council is great to work with. They're on top of their stuff. So we're very bullish.
So let me ask you from, Austin, obviously we know the explosive growth going on around here and the surrounding areas that are all located in the Austin Round Rock MSA. We've got an abundance of employers looking to hire high quality individuals, ranging from tech to everything else under the sky. What are some of the employers in Seguin? I know they've got a couple of smaller universities there. What is appealing to Seguin? And when you're looking at areas, obviously, when you're looking at market, what is most appealing to you as a developer about Seguin?
Yeah. So top 3 employers: Caterpillar, Bicycle Technologies, and CMC Steel, Texas, right? That's roughly 10 to 20% of the job force, right? So again, advanced manufacturing. But the one beacon that I think is coming to market here pretty soon, and it's already been in the news, is that Micron has more or less announced a location west of Lockhart, which is about 20 minutes from Seguin. Why is that important? Well, if you look at what happened in Taylor, which is almost an hour northeast of Austin, Samsung announced a $15 or $17 billion investment, 6,500 jobs. That doubled land prices in 4 weeks. And I can't tell you how many developers chase that market for land, to a point now where I can't just find any deal out there. Well, Micron is expected to announce 2x that investment, right? And the job growth expected is that equal to Amazon HQ2. So you think about what that's going to do for that entire corridor. It's going to blow up not just Seguin, but it'll blow up New Braunfels. It'll blow up Lockhart, Luling, San Marcos. That whole corridor, we believe, is going to blow up and catch fire. And that is why, as I mentioned in the first part of this segment, that's why we picked up nearly 700 acres in the last 4 weeks. We are thinking that there's a big wave coming of demand.
Yeah, no, I think that is all phenomenal information. One of the things I was looking at was the overall cost of living index, which has Seguin at 95.4, really in the middle between San Antonio at 91.9 and Austin at 99.5. So that source is Jobs EQ. So thank you for.
That's a few months behind the curve, but it's interesting. Austin, in a lot of ways, housing is outrageous, but it's still fairly affordable to live. Yeah, and Seguin's about 6 to 8% cheaper than Austin. Yeah.
And you mentioned this, but Seguin is all about manufacturing. And one of the things that I was noticing as I was doing research, Seguin has 3 times the amount of manufacturing jobs compared to the national average. So is Seguin potentially the new manufacturing hub of Texas?
Yeah, I mean, frankly, Austin, in its entirety is the mecca of semiconductor manufacturing, which is, we know, with TSMC in Taiwan and that China conflict, that's a big risk. I think that's why we're seeing them come to Austin. Pro growth, low taxes, they get tax benefits from doing so. And so, I think Austin's going to be a hub of advanced robotic manufacturing. I'll tell you, there's a company called Ironox who is near one of our other areas in Lockhart. They're bringing like robotic farming to Austin. So there's all sorts of cool advanced manufacturing coming to this area. And so, I think we're going to see more of that in these markets. And by the way, real quick, I just realized Seguin population has increased 18% since 2010, which is, again, that's a boom growth rate. So
you've got machinery manufacturing, fabricated metal product manufacturing, food and beverage manufacturing, plastics and rubber manufacturing, as well as retail. So definitely a manufacturing mecca, as we will call it in Seguin. So definitely a lot of headwinds for the Seguin marketplace. I like it. I really do. I think, just given its location, I think, certainly there's a lot of dynamic reasons why Seguin is.
Yeah. And this deal is, it's located about 10 minutes from Texas Lutheran University and about 12 minutes from the city center, which is where more or less all the jobs are, right? But more importantly, it's located 3 minutes from a high school. So it's 1.8 miles from the main high school, which is called Navarro High School. So location's prime, and it's got a beautiful creek running in the back of it. It's 80 acres total, but 16 of it will be parkland. So,
yeah, and over the last couple of years, you've had some big announcements from some big companies. Abbott, they announced a new manufacturing facility in Seguin. United Alloy, they a few years ago were committed to building a $35 million manufacturing facility. Niagara Bottling, they announced an expansion there. So definitely a lot of great things happening there. That covers, really kind of the marketplace. Let's talk about the property and the property details in itself. One of the things that I look at when I'm evaluating a deal on property is obviously, what was the comparable value or comparative relative to other acquisitions for that same acreage. So this was give us the details on what was appealing on this. I know you look at tons of opportunities out there.
Yeah.
What made you pull the trigger on this?
Yeah. So Seguin, again, one thing that my company is constantly trying to do is figure out where are the builders moving, right? You don't want to be buying behind the trend, especially in this business. So we're always trying to figure out, okay, well, where is their next market that they want to build in? Because where that's at is where we'll get the best prices on our land. So these 80 acres are coming in at a total of, I believe, $4.7 million, right? So what we're seeing in the market where it's prime location, the cost per acre is around $85,000. So we're in this one for $65,000 all in per acre. We feel that's a pretty good discount for what it should be. And the property itself will produce 380 single family lots, right? So that's about a 24-month window for us to get in. So total 3 years because we do engineering and entitlements, but the actual work itself and the selling of lots is about 2 years, right? To sell all those lots. The lots themselves will sell for about $80,000 a piece to builders. And the way that you figure that out generally is what's the anticipated home price? Well, we think homes that the builders will build here will be in the $350,000 to $400,000 range. So typically lot prices are 20% of that. So it's right in that ballpark of around $80,000 per lot, which is where we need to play. The land itself, it's very attractive in terms of the big oak trees that are on the land. It's a nice flat parcel. It's tons of road frontage. There's a massive sewer line and water line right in front of the property. So in general, it's a really ideal property from location, from what we think will be a fairly straightforward and easy construction process. And again, it's prime for the selling to builders.
I love that. So let me ask you this. When you look at the comparables of what a finished home might look like, which obviously factors into what you're going to, sell to the builders, and when they're evaluating it, what type of home prices are you going to be seeing in that and price per square foot that is going to be attractive to the builders as well?
Yeah, so it's a great question. And what we do as well is before we buy land, we say, well, what else is sold in the area for new homes, right? And there's a community a mile or two away. I think it's
that Arroyo Ranch.
I think that might be it, but there's another one too. Home prices are selling in the low 3s to mid 3s fairly easily. There's a few anomalies that are selling in the 4s. We are confident that our comps in the $350,000 to $4,000 range, especially in 12 to 18 months, given that just yesterday, I think it was Bank of America came out with a 10% appreciation rate for the year. Might have been Chase at 15%. So even with interest rates, they're still predicting appreciation. But take that away for a second, we still think that our price points are right in line with prices of today. So that's how we found the comps. What that means for the kind of home, expect 1,200 to 1,600 square feet, right? Maybe we get up to 2,000 on some of the 2-story builds. We'll see. That's on the builders to decide. Still, today's market, we think builders are building in the 140 to 150 per square foot range. So if you do the math there, they try to make 18 to 25% margins. So that all lines up exactly with our price points and what we think will be $350 to $4,000 on the homes.
That's perfect. That's exactly what I want to see. One of the things I always look at is the overall market from a real estate perspective, because ultimately, as investors of the deal here, and we really haven't got into that. We're really talking more about, the makeup of the deal rather than just selling the promise of the actual investment. I always like to, really kind of educate our listeners and educate myself before we kind of blur any type of analysis by really attractive investment returns, which this does. But ultimately, your project hinges on a builder coming in and purchasing the lots. That's it, right? So it has to be attractive enough for you guys also to make a profit on the development and getting these builder ready. And then for a builder to have the opportunity. And that's why I always like to do the market analysis, because if the market is dynamic and the numbers of the acquisition for you make sense, then we hope that translates into a builder coming in and either doing the full takedown, or you've got a couple of builders, very similar to the deal that we did in Lockhart. And that right? I mean, that's ultimately
100%. I think it's important to dial or, dig deep a little bit here. A lot of developers, and it's somewhat unfortunate, but I see a lot of developers miscalculate assumptions or look at, profits on paper in one scenario and just proceed. We have in our modeling all different scenarios. We have just on the single family pro forma alone, we have 5 different scenarios, understanding the bandwidth of profits. We have a scenario where we assume a 20% crash in the market, right? We have a scenario where we assume we're not even doing the horizontal construction. We're just going to sell it as entitled lots, right? The only way that we proceed on a deal and say, yup, this is one that we want to put our own money into, which we do in every single deal, it has to make profits in every single scenario. And if it does, we're comfortable that, hey, in a downside situation, we still make money. Hey, in a situation where we don't know how to do the construction, we still make money. And then of course, in horizontal, then we obviously make money too. So
I looked at that and I appreciated you throwing that in, because I think even with the 20% correction, let's walk through those numbers. If you can pull those up for me and walk through those different scenarios where, if we do see a 20% correction, because ultimately this investment is a profit share. This isn't something where it's a preferred rate of return and has some hurdle. You are aligned with the general partner, which would be Red Oak in this scenario, yourself. Walk me through these different scenarios. I think it'd be extremely helpful.
Yeah. So again, this is our standard process in every single one of these deals. And so what we'll focus on, again, it's pretty straightforward. It's low, mid, high, and high. And what's amazing is whenever we go out and negotiate with the builders, we start at high, right? We say, hey, we're willing to sell these lots at $82,500 a lot. Do you agree? And what's amazing, this is evident of the strength of the market. We have not once had builders push back on our high pro formas, right? But again, we still need to assume a range. So we have a range here of where we think we'll play. And obviously this is how we drive our negotiations. So let's not get this out to the builders. But here's a scenario where we say, okay, great. Well, what if there were a crash? And this crash, by the way, is off the low scenario. Okay. So what if we have to do a fire sale at $58,000 a lot, which would be, I haven't seen a lot that low in, 2-3 years. So we assume everything else is equal. The cost to build, the cost of capital, the cost to our investors, the cost of OpEx, the cost of engineering, nothing else changes, but just the top line, okay? And I'll spare you some of the details. It's a long P&L of line items that down.
I looked at all of it, by the way. I looked at every single
job site security. We have toilets in here. You name it, it's in here, right? We have all of our permits and entitlements and operations.
You know what you didn't do? Can I just interrupt?
Yeah, sure, go ahead. Mm-hmm.
In a 20% crash, okay, or recession, one of the things that you didn't do, and this is something that you can consider, so this makes your estimates a little bit more conservative, but from a macroeconomic perspective of looking at supply and demand, we have a recession, correction, crash, call it whatever it is you want. All of those things that go into the development, all of those things that go into the building, the materials, they should also experience a decline. Nowhere did you have that in there, by the way.
That's right. Well, again, this is why we
being conservative. That's
100%
speculating, right? But just something that I noticed that I think actually just makes
it's a great call out. Yeah, but I think for the audience, we want to keep it apples to apples, and you're absolutely right. Obviously, commodities kind of typically move and flow with the growth of GDP and obviously the output of our economy, right? So. But let's just assume that it is the worst case scenario. You can see that even in a crash, this profit still $4.4 million, give or take. And in our profit share, which is 25% to the investors, they still pocket $1.1 million in this scenario. Right. They're
still going to make money in a scenario where the market corrects itself. There's always the ability to, and I don't know, Tom, if this has ever been a thought, but to repivot. A couple of things that you mentioned was, we're looking at developing this, but I think being able to pivot based on what the market gives you. And then at that point, you can say, you know what, we'll just bring this in-house, we'll develop all this, and we'll actually do a rent to own or something like that, where you've got the ability to be flexible. Have you ever thought of anything like that?
That's a great point. So, we've already talked to the city of Seguin, right? We said, hey, here's our idea, right? Single family lots, 380, easy peasy. They're like, great. Here's a timeline. Okay, awesome. But we also talk about, okay, well, also, what if we need to build townhouses ourselves, right? And again, townhouses should be a fairly easy sell in the market. They're somewhat easy to build. You can, hammer them out fairly quickly, and they become an asset that we can sell and own, right? And keep it in-house, to your point. And we like when cities say, yes, we're open to that as well. Seguin actually encouraged it. They say, we need rentals. The demand's coming. We need cheap housing, affordable housing, and rentals. So we absolutely would entertain you doing a mixed use or the entire community as rentals or townhomes.
Yeah, you've got that ability, and then ultimately you can sell that cash flow to, there are so many institutional investors out there looking for exactly these types of assets. So I think, when you're looking at that pro forma, obviously the data, what it helps me do when I do my evaluation is ask the operators, folks like you, qualitative questions that we then can look at alternative scenarios. And I think that's extremely important when you're looking at a deal, because, that flexibility is key. If you're going to restrain yourself to only being able to do X, and now the market is giving you, and after watching Man in the Arena, and which is about Tom Brady, and I'm a bit of a Tom Brady homer, he always makes a lot of life analogies and relates them to sports. And I kind of look at an operator being able to walk up to the line, read a defense, and you're going to the best quarterbacks. What makes Tom Brady great? And I love how we're talking about Tom Brady on this real estate deal. I think it's awesome. But he exploits what the defense gives him. Right. And ultimately, a great operator is going to be able to take a step back and say, what is the market giving me right now? And being able to take advantage of that for all parties involved. So I love that. Great analysis. Thank you for walking us through an Excel spreadsheet. I am sorry to our listeners and viewers who had to look at an Excel spreadsheet. I personally really enjoy looking at spreadsheets because I think it really paints the investment and it gives you the inner workings of really how we arrived at all of those numbers. And I think it's really important. So lastly, the operator, I think this is extremely important in any business. I think if you've got the capital, I think if you've got, a great market or geo, as we call it. And, again, we talked about the property. All that can go bad if we don't have an operator that knows what they're doing with an experienced team and somebody who understands, what the development looks like. So what number project is this in the last 12 months for you? I believe.
Yeah, one, you all should thank Mitch for hammering this because I think a lot of these, crowd streets, and nothing wrong with them, but there's not enough vetting on the operator. And I really appreciate your focus on this. And with Rob Anderson and team, we talked about the same thing. There's a lot of people coming into this market and I see a lot of sloppiness. They have some capital, they pick up some deals, they pitch a game. And I really worry about those projects. And so let me just start by saying, if you really want to know about who I am and how I got here, I just put on what one of my capital buddies told me. He said, you need a brag sheet and you need to make it public. So it's on my website. If you go to our website, redoakvc.com, under About Us, you'll see more about Tom. If you want to know my journey and how I got here, that's all there. But what I'll tell you is that we are absolutely maniacal about organization, planning, and ultimately that leads to hopefully successful execution. Even today on our city call of Lockhart, they said, "Wow, you guys sound like you're operating a rocket ship," right? Because everyone was like, "Where are we on this? Where are we on that?" It's an orchestra, and I am
Elon Musk.
Yeah, well, I'm not that, but I am very proud of my team and how organized they are. We just, to put it in perspective of how maniacal, we just decided in the last 2-3 months to build out an engineering firm and bring it in-house because we want to control the A to Z process, ensure our timelines are tight. We're building out a crew. We just hired our first PE on staff. We're hiring 2 designers. That's under the firm Viewpoint Engineering. So very seasoned team that we have there, and we're going to keep hiring to scale up, effectively and efficiently. Yeah, right now we have about 700 acres in addition to a big one that we're doing in Lockhart, but the ones we have under our belt, it's officially 689 acres, 2,064 lots in development, a pipeline of $188 million, 6 active projects. And then we're now expanding in Arizona as well. We've exited 2 successful deals there. We just picked up another 80 acres in Arizona, and we're looking at a 5-story building in Flagstaff. We have officially 8 people now in the Red Oak team, and we're constantly expanding. So, right now we're hiring some analysts. I just hired an economist from Penn, given that these are crazy times that we're in. And so I need someone full time on this to be researching. So she has a PhD from Penn and a master's from Johns Hopkins in journalism. So she just joined. And so, yeah, we have a great team. I am by no means the sole success story here. It is without my team, I would not be here in the first place. So that is what I'll say. There's a long journey of who I am. Go to my website, check it out. I'm happy to answer any questions you have.
Tom, and this is something that's really important. So when I do my due diligence, and clearly, when I look at someone's background, I do a full scope check. I do a full background check on them.
Yep.
I want to know exactly who I'm working with. I'm not so sure that, I think people are too trusting. I am a trusting individual, but I still need to know as a fiduciary, I have to know who the folks are. That's step one. But the other things that people don't think about when I do my due diligence, and the folks and operators with specific deals that I bring to my investors, it starts there. But then one of the things that impresses me is the communication. And when I sat on CrowdStreet's annual call a few months ago, one of the things that jumped out at me, I always, I mentioned this before, but I went to the chat box and I was reading the questions that they wouldn't answer. And one of the things that they said was, you guys, CrowdStreet was vetting, quote unquote, vetting these folks, but these were developers who weren't used to working with individual investors. And one of the things, and I learned this because my wife is a marriage therapist, communication is the key to any relationship, not just in the house. You've got to be able to communicate. And you also have to be able to offer a seamless onboarding, because sub-document onboarding can be really annoying for folks that aren't used to it. So I commend you on your proactive communication. I think that's really important. And I think having seamless onboarding and somebody to walk you through those sub-docs is equally as important. I would also recommend that you hire, even if it's somebody that you got to pay per hour, hire a real estate attorney to review the docs. If you're going to invest thousands of dollars, always have an independent attorney review that and just make you aware of certain things. I just think it's really important and goes overlooked. I am literally in the middle of reading a full safe note for a startup in the benefit space. And so I literally am going through every paragraph and section, and I want to know what I'm getting into. So I think that's extremely important. Again, kudos to you for kind of offering all that. I hope that today was, just a good learning experience for those folks who want to understand kind of the inner workings of evaluating a deal. But let's get to the deal, because we really haven't talked about returns all that much. So I know you had that spreadsheet out, and without bringing the spreadsheet out and having people fall asleep at their desk in front of the computer, let's look at your low. And at a 25% profit share on an equity raise of $3.5 million, first and foremost, of the total equity needed for the deal, not just the $3.5 million, how much are you contributing as Red Oak or individually as Tom Staub?
Yeah. So what I tell you is a benchmark for contributions on our end is between $50,000 to $100,000 per deal. You can imagine now having 6 active deals in Austin, that builds quickly, right? So if I'm being transparent with everyone, this is, in my opinion, our best deal yet. And mainly because we got the land at such a good price, and the spread between our exit sales price on lots versus our acquisition is the biggest we've had on any deal. Okay. So if I had an appetite to only do 6 deals and I could deploy all the rest of my capital in a deal, this would be the one that I would do it. Now, this is why we've structured this deal in a profit share, because we could do a pref return, which is what we usually do in the 21 to 25% range. But what you'll find in working with me is that it isn't always about numbers. And there's a reason that every investor I have had in a deal has stood with me through every other deal that I've had as well. And so we're making this a profit share for investors, because I believe, and again, it's all estimates, but our target IRR over a 3-year period is on the low end, we think it's 30%. Now, I won't get into details in this call, but there are other ways that we're going to squeeze more juice out of that fruit, right? 2 quick ones is we just finalized a partnership with a company called Centric, which is a fiber and gas company, okay? They give us 10 years of kickbacks in their revenues for any community that they come into, right? That's roughly another $1 million of profits in this deal. So investors get a piece of that for the entire 10 years as well. They get profit sharing on the actual proceeds from our lots, which again is a takedown of 2 years, right? They get tax write-offs in year 1. We're going to have a loss because it's all OpEx engineering and all that, right? So that's a nice tax benefit. And then additionally, there's something, and without getting again into the details, in Texas, basically the cities allow developers to get reimbursements for the horizontal development, that meaning infrastructure, utilities, roads, what have you. Now, Seguin tends to be a city that helps developers do this. If we get this passed, and it's not always a guarantee, if we get this passed, the reimbursements could be as much as $8 million in the project. Okay. And again, that $8 million is an additional $2 million to investors on top of our profits. So that pushes the IRRs, and it's almost embarrassing to say, because you would think that you would call me crazy, and I'm telling like, what are you saying? But that could push the IRRs into the 45 to 55% range, which is,
that would be outstanding.
I mean, that's unheard of. And it's frankly, I wouldn't have to do that to sell the deal, but those are not guaranteed. So we have it as a potential kicker, but we don't bank on that. So we assume in our worst case scenario modeling, the IRR that we're targeting for investors is in that 30% range.
Let me ask you this. You have a partner, I believe, Aspire Partners.
Yep, that's right.
Explain their role in the development.
Yeah, so Aspire Ventures is headed up by a fellow named Ramana. I won't tell you his last name just for privacy, but I can give you the first. It's Ramana, and he did the biggest transaction in Dallas for a syndication in last year, a 2,600 unit exit over 9 different projects at once. Okay, his resume. I always tell a story, and it's in the deck. When I was trying to figure
his last name in the deck, did you mean?
Oh, okay, so then it's Ramana Karada, and he's in the deck. So if you're interested, we'll share it. But anyways, his resume was so long that for me to fit it on the slide, I had to use a 4-point font. So I had to.
I'm looking at it. I need a microscope.
It's really incredible. Yeah. So he is one of our partners that gives advisory. But more, even more important, I think, is our senior advisor, David Wilson, who is the biggest developer in Hawaii and one of the biggest developers in Southern California. This guy has 40 years experience. He builds hotels, theaters, stadiums. I mean, it's resorts. He is next level. So we use him for advisory to ensure we're not getting ourselves in traps. So with him and Raman on the side, and then me, and of course my entire team, we have an army to come at these projects and really dial it in. So
does Mr. Karada and David Wilson, are these folks who really are on your advisory board, and you give them a piece of the GP economics?
That's right. So yeah, that's important. So when we talk about profit shares, the way it works is, let's just say for easy math, we make $10 million, right? When I say we, that stays into a bank account. The first people that are paid are the debt. Obviously, they have the lien against the property, so we pay off any debt, which is via construction loan. Number 2, investors. Okay, investors get paid that. The remaining goes to Red Oak. A piece goes to David. A piece goes to Ramana, and that's how we're all paid in the end. But the waterfall, as they call it, goes senior debt, investors number 2, and then us number 3.
Lovely. I think we covered it all, and an awesome episode as usual. I'm very happy that we got into this. I'd like to see us do more of these and really kind of look at deal by deal. That was kind of the intention. And, we've really met with individuals who are other developers. And I would really like to get into more deals. So more to come. I am in charge of booking the guest, by the way. So we've got to do more of that. Guys, it's always good to see you, Tom. To the folks that listen, hopefully you got some value out of this. For more information and you want to talk to Staub, Tom, I combined your first and last name there, by the way. So a little tongue twisted. You know where to find him. You know where to find me. Thank you. And we'll see you next time. Take care.
Thanks.